So welcome back. So how does gifting property to children compare with using a family investment company as opposed to giving that property directly to your children? So in the majority of cases, we advise our clients not to gift, well, money or property, frankly, directly to their children, including any minors. So basically the reason for that is that the divorce rate for an under 40-year-old in the UK is over 56%, and therefore it's a big risk to give significant assets away to your children until you absolutely have to. So I'm saying when you're around 75, frankly. Okay, so gifting a property directly to your children is also worse than a family investment company, because there's a potential capital gains tax liability, which could be 28%, and also stamp duty, land tax payable if there is a mortgage on the property. So it's a more sensible route to use the family investment company route, provided you can claim incorporation relief. Now, I won't go into that today. That's covered in some of our other videos around how to set up family investment companies. So the method of using an FIC helps you to avoid both the capital gains tax and the stamp duty land tax. Now, your children can live in the property even though it's owned by the company, as long as they pay full market rent. But of course, it also doesn't belong to them, and therefore if that property is sold, the gain goes into the company and is subject to corporation tax, and there won't be any private principal private residence relief on that money. So if your children plan to live in the property, then it may be a better route to actually gift it via trust, providing the value isn't over your allowances for trusts. Then your children could live in that property and they would get principal private residence relief because they are beneficiaries of the trust. And in addition, the protections of the trust would also apply. So another major benefit of the family investment company is that it does avoid inheritance tax on the value of that property, as well as avoiding the capital gains and stamp duty land tax. Of course, the inheritance tax saving is only made provided you gift the shares of the company away in a timely manner. Again, that's covered in other videos. So in the unfortunate event of your children getting divorced, which is why I'm saying we should do it that way, the family investment company does protect the assets to a very high degree, not 100%, not quite as well as a trust, but still very well protection. And again, this is covered in the videos around why landlords should use family investment companies. So provided you have enough property to claim incorporation relief and set up a company, you should give property to your children via this mechanism rather than directly. So in summary, gifts to children of property via trusts or family investment companies is usually a much better route than giving it to them directly, because of the issues around stamp duty, land tax, capital gains tax and divorce. Okay, so hopefully that helps. Thanks for listening, and bye for now. Bye.